If you had $1,000 today, not 10,000, not a million, just 1,000, what would you actually do with it? Most people would spend it, some would save it, but very few would invest it with a clear plan for the next 10 years. And that is where the real difference begins. Because $1,000 is not life-changing money, but the habits formed by investing it absolutely can be. Many people believe investing only matters when you have large sums of money, when you finally reach 10,000 or 50,000 or 100,000, but history shows the opposite. Wealth rarely begins with large capital. It begins with disciplined allocation of small capital. In fact, some of the most successful investors in history began with very little. Warren Buffett bought his first stock at the age of 11, 3 shares of Citi's Service Preferred. He invested around $114. It was not a fortune. But that early investment did something more important than grow money. It built a mindset that treated money as something to deploy, not simply consume. And over time, that mindset compounded into one of the greatest fortunes in modern history. So imagine starting today with $1,000, not trying to get rich quickly, but investing it intelligently for the next decade. 10 years is long enough to experience market cycles. There will be optimism, there will be fear, there will be corrections. But history suggests that patient investors who stay consistent often benefit from long-term economic growth. The key is not complexity. The key is structure. The first rule of investing is simple. Do not lose money unnecessarily. This principle has been repeated by investors for decades. Benjamin Graham, the mentor of Warren Buffett, emphasized this idea constantly. In 1929, the stock market crash wiped out enormous fortunes. Speculation had dominated the market. Investors borrowed money to buy stocks. They concentrated heavily in a few positions. When the crash arrived, losses were catastrophic. Benjamin Graham himself lost significant capital during the collapse, but the experience shaped his philosophy. He later developed the concept of the margin of safety. The idea that investors should protect themselves against uncertainty. So if I had $1,000 today, I would begin by avoiding unnecessary risk. That means no speculation, no chasing hype, no gambling on unproven trends. The most reliable long-term strategy for small investors has historically been broad market ownership. Instead of trying to pick the single best company, own many companies at once. This approach became popular through index investing. In 1976, John Bogle launched the first index fund available to everyday investors. Many critics dismissed the idea. They believed professional stock pickers would outperform. But over the following decades, index funds consistently beat the majority of actively managed portfolios. Why? Because markets grow over time. Companies innovate. Industries evolve. Productivity increases. Owning a diversified index means participating in that progress. So with $1,000, a large portion would go into a low-cost, broad market index fund, something that tracks the overall economy. This creates exposure to hundreds or thousands of businesses at once. Technology, healthcare, energy, consumer goods. Instead of betting on one winner, you own the system that produces winners. Now comes the most difficult part, holding through volatility. History makes this clear. In 2008, the global financial system nearly collapsed. Major banks failed. Markets fell more than 50%. Fear dominated every headline. Many investors sold their portfolios to avoid further losses. But in March 2009, the market began a recovery that would last more than a decade. Those who stayed invested saw their portfolios multiply several times over. The lesson is powerful. Crashes feel permanent when they happen, but historically they have been temporary chapters in much longer periods of growth. Consider someone who invested $1,000 into the S&P 500 at the beginning of 2010. At the time, the global economy was still recovering from the financial crisis. Confidence was fragile. But over the next decade, innovation accelerated dramatically. Smartphones reshaped communication. Cloud computing transformed businesses. Artificial intelligence began advancing rapidly. Companies like Apple, Microsoft, and NVIDIA expanded globally. The S&P 500 more than tripled during that period. That original $1,000 would have grown to several thousand. Not through perfect timing, not through constant trading, but simply through ownership of productive companies. The truth is that $1,000 alone rarely builds substantial wealth, but it can begin a system. Imagine adding just $100 per month after that initial investment. Over 10 years, that would add $12,000 of additional contributions. Combined with market growth, the portfolio could potentially reach $20,000 or more, depending on returns. This is how investing becomes powerful, not through a single decision, but through repeated discipline. 10 years is long enough to see the power of compounding begin to appear. But the real transformation often happens beyond that horizon. Compounding behaves quietly at first. In the early years, growth seems modest. But as the base becomes larger, returns begin generating their own returns. This is the same principle that allowed investors who stayed in the market through the oil crisis of the 1970s, the crash of 1987, the dot-com bubble of 2000, and the financial crisis of 2008, to build enormous long-term wealth. They did not predict each event. They endured them. Ownership of productive assets allowed them to benefit from decades of economic expansion. The global economy has faced wars, pandemics, recessions, and political turmoil. Yet over long periods, innovation and productivity have consistently pushed markets forward. Investing is essentially a belief in that long-term progress, a belief that businesses will continue solving problems, building products, serving billions of people around the world, and investors who own pieces of those businesses participate in that growth. $1,000 is not a fortune, but it is a beginning of discipline, a beginning of ownership, a beginning of thinking differently about money. If invested wisely today, it may grow into several thousand over the next decade. But the real value is larger than that. Because once the habit of investing is established, every future dollar can follow the same path. History shows that wealth rarely appears suddenly. It is built quietly, through patience, through discipline, through ownership. And sometimes, it begins with something as simple as the first $1,000